What's going on, guys? Josh Baldwin here, founder and CEO of Flyer. On this channel, I focus on offering personal finance tips as well as provide entrepreneurs with real-world financial knowledge, business coaching, motivation, and training. Thank you to those of you who watched last week's video. Hopefully you were able to learn some valuable ways to pay off large amounts of student debt as quickly as possible by becoming skilled at money management. In this video, I wanted to share with you exactly how I was able to purchase my first home at the age of 25. More specifically, I wanted to focus less on how I was able to come up with the money to purchase this home and more on the actual steps to get yourself into your first home. So if you're a renter, or maybe you live at home with your parents, or you're just exhausted from researching countless articles online and you really just need some solid information that's going to give you a bit more comfortability when you're trying to look for your first home. If so, this video is for you. Now, before I get into it, let me first disclose that I am not rich, I am not Dan Bilzerian, I am not a trust fund baby. This property was purchased entirely on my own without any sources of outside funding. Now, if you're more interested in learning the financing side and how I was able to come up with the money to purchase this property, then you'll want to watch my first video, where I explain how I took advantage of the CARES Act and used it to withdraw funds directly from my 401k into my bank account. All right, let's get into it. The first thing I want to cover is how to determine what kind of house you can afford to buy. So when you're first looking for a home, the first thing you want to do is look for homes in your price range. Now, if you're still in the early stages, you have the option of using a number of online calculators where you'd manually input your financial information and at least get a general ballpark figure of what you can afford. This is definitely a good option for fresh buyers that don't want to run the risk of hurting their credit. Because when you're in the later stages and you've actually made the commitment to buying the home, then it's a matter of shopping around different lenders and getting a quote to see how much house you can actually afford. And the way lenders determine how much money they're willing to lend you to buy your first home is by requesting hard pulls from your credit card company. This typically doesn't have a huge impact on your credit score, but it may dip a few points depending on how many quote applications you fill out. The next topic I want to cover is how to search for a home and how to secure a realtor. Now, when you're shopping around homes on the internet, I always found it best to look at a couple sites rather than just one. Sometimes Zillow can provide information that Redfin can't, and vice versa. These sites are not always updated at the same time. For example, a property could show up as sold on one site and pending on another. So you'd be doing your due diligence to check at least a few. Now, when it comes to picking a realtor, don't pick the very first one that pitches you their services in the most eloquent way. Let me first explain to you a couple of strategies that will vastly improve your experience and make the whole process run a lot more smoothly for you. First off, you'll want to target experienced realtors that are well connected with other lenders. Now, this is very ideal for a number of reasons. Realtors that can refer you to a recommended lender will be in the position to not only help you locate a home, but also assist in the process of securing your loan to buy that home. These kinds of realtors generally drive a lot of referral business for other people. And as a result, they also receive a lot of referral business. In fact, referral business is the number one marketing tactic both realtors and lenders use to gain more clients. So if you can find a good realtor that can recommend a good lender, then you're essentially setting yourself up with your own team to help you through your real estate deal. This also greatly helps with communication because everyone involved in the deal can stay on the same page. Your realtor will be able to stay informed about how far you are in the loan process and be able to guide you through the home buying process a lot easier. Now, if you're in the situation where you've already chosen a home and now you need to find a realtor to carry out the transaction, there are a couple of things to look out for. First off, you might be tempted to pick the very first realtor you see under the listing to represent you. This is something called dual agency, and it's something you want to avoid. Picking a realtor that represents both you and the seller is generally a bad idea because it encourages the realtor to convince the seller to sell at the highest price possible. Not only that, but a dual agent receives double-ended commission on the sale of the property, which means they receive commission from both the buyer and the seller. Whereas in an exclusive buyer's relationship, they would only receive half of that. So as a buyer, it's in your best interest to pick a realtor that's going to put more focus on the buyer rather than the seller. Now, the last topic I want to discuss is debt to income ratio. This is what banks and lenders use to determine how much you earn versus how much you owe. And hands down, the most important factor lenders consider when they're determining how much of a loan you can afford to pay back over the 15 or 30-year term. Similar to the home cost calculators, there are a number of debt to income ratio calculators you can use as well. However, the most accurate ratio you'll receive is from the lenders themselves when you give them a call regarding your quote. Now, say you found the most absolute wonderful home of your dreams, but then you go to fill out the application for the quote, and your lender tells you that you're at way too high of a debt to income ratio. This is actually something that happened to me when I was purchasing the home that I'm filming in right now. I checked out the place, I loved it, I was telling everyone about it, but I was just barely over the debt to income ratio limit. And it completely bummed me out because that was the only thing that was stopping me from getting into that home. Until I figured out a few strategies. First off, if you're not in a rush to move into your first home, the easiest thing you can do is ask your lender exactly how much debt you need to pay off. And then simply continue going to work and earning income to pay down your debts. On the other hand, if you're in a rush to move or you're just really excited to get into your first home, there are a couple of ways you can instantly lower your debt to income ratio just enough to qualify for your loan. One thing you can do is simply call all of your loan companies and get them to refinance your payment. In my case, for example, I was able to refinance my auto loan, my student loan, and even my car insurance. Make as many calls as you need to and refinance as many loans as you have to lower your debt to income ratio below the limit. Because when it's all said and done and the lenders reran your calculations, now you'll be below the cutoff and now you can purchase that home. Alright guys, I hope you guys found this video helpful. If you did, please leave a like, subscribe, comment, turn on post notifications, all of that good stuff. As I mentioned in the last few videos, I upload new videos every Thursday. And as always, stay hustling and I'll see you guys next week.